The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. E.G. Tax.
It's Ask the Tax Lady with Esther Gulius and E.G. Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Well, hello, everybody. It is E.G. Tax here. Obviously, I'm not Esther, giving her the Saturday off. But this is your hour to get your tax questions asked and answered. Free, of course. Give us a call in studio at 803-0930, 803-0930. Text them in at 716-803-0930. Today I'm here with my beautiful wife, Tiffany.
Hey, happy Saturday.
Happy Saturday. It's gorgeous.
Yeah, absolutely. And then, I was eating lunch with my daughter and her boyfriend, and his mom called him up, and I thought this was apropos, and he got a letter from New York State Tax and Finance in the mail. And so we're still getting letters, right?
Getting the letters,
Yeah. And most of them, what are you seeing still?
Just asking a lot of it's still verifying stuff.
Yep. That's what I was telling them. Verifying your identity. And if you don't do it, your refund is held up, and it'll be held up next year. So if you need help with that, just give us a buzz throughout the week at 632-7886, and we'll be delighted to help you, right?
That's right. And our tax school is starting soon.
Yep.
Starting in September. So if you're interested in that, give our office a call. Go to our website, egtax.com. We'd love to have you in our class. We have early bird specials. We have like a 2-for-1. So if you and your friend want to take the class together, we encourage you to do that too. know.
And then today, as our guest we talked about last week is Jeff Katz, and he's from Katz and Berry, and he talks about elder law and elder planning, estate planning, and we've had him on for years and years, and it's a really important topic, and so make sure you get your questions ready. Jeff Katz works at the office on Main Street in Williamsville, and Jeff, what is the phone number there?
Our phone number at the office is 633-3363.
Great.
Yep. And, that's Esther highly recommends using Jeff.
Well, thank you, Chris. Esther and I have actually been doing business together for over 3 decades, I think, at this point, and always enjoy joining you here on your show pretty much once a year for the last many years now. So thanks, guys.
Yeah, Esther talked about a topic last week, Chris and Jeff, and that was a change in irrevocable trust. And Chris, you want to lead into what Esther was talking about?
Yeah, back in March, they snuck in.
Yep, Revenue Ruling 2023-2, I believe it was.
Precedent.
Yep, which so it changed the taxation on irrevocable trust. So most people would get very nervous when they hear something like that. What does this mean to me? How's it going to affect me? And I have had, we've dealt with this somewhat in the office. So for most people, it's not going to affect them at all, even for many people who have irrevocable trusts. The issue is really one of basis. And so if we just take a step back for the listeners, what basis is when you own something, let's make it a stock. You bought it for $1, you sell it for $10, you're going to pay capital gains tax on the difference between the $1 and the $10. What the revenue ruling did addressed the taxation of that upon death, and whether what's called the stepped-up basis is available. Stepped-up basis is something that is currently available to all taxpayers who own stock or even houses, so that when they pass away, the basis would step up to the value at the date of death. And this new revenue ruling affects that for assets held inside of an irrevocable trust. So I think the long and short to that answer is, if someone does have an irrevocable trust that has assets in it, we got to be careful about what's in there and how it's going to be taxed at death. Because in short, it's not a good ruling for taxpayers.
Yeah, there was a texter last week, Chris, correct me if I'm wrong, and they said that they had an irrevocable trust. And so their question was, should they change it and get out of that situation? and they had assets in it.
Yeah. So, and that's a good question. It's, I think, in this format, in other words, just kind of talking on the radio, it's really almost impossible to answer that question for somebody. We would need to sit down, with accounting experts like yourself and legal experts to really take a look at the answer of whether you should unwind, and even if you can unwind what's inside of an irrevocable trust. But I think the importance for anybody who's got an irrevocable trust with this revenue ruling is we do have to revisit that, so that to make sure that they're not going to get an unexpected tax consequence. Because as I said, this revenue ruling will affect anybody who's got assets held inside of that irrevocable trust.
I know I'm talking to you, like we said, you've been on for over many years. The only way out of a irrevocable trust is if all parties agree to cancel it.
So if you have an irrevocable trust, as it is named, it is not revocable. So it can't be just the grantor, the person who set it up, can't just say, okay, I want to change it now. It's always subject to the terms of the trust, but in concept, you can't. When you set this up, you set it up, giving away the assets, put them in the trust for various reasons. One of the common reasons is what we call elder law, trying to protect the assets if they go into a nursing home. But unwinding of an irrevocable trust is not easy and would take some pretty sophisticated work, and everybody would have to agree. You can't just, because people who are being harmed by any actions that were taken would have rights that would have to be protected there. So yeah. So it's not a simple solution, like you said. Really can't just answer it on a simple phone call. No, it's for us to talk about it in the abstract is very tricky. But it is, I think, the important part for anybody who's listening who does have an irrevocable trust to know is that the federal government did pass this or create this revenue ruling, and it will impact the way trusts are taxed at death. So when the trust was set up, it might not have the same goals or same benefits, and that's unfortunate. But we always, as Chris, Tiffany, as we always talked about, laws change, and we always have to be on our toes to make sure that we're doing the best for our clients and the people we're trying to help when these laws change. So.
Oh, sorry, but you hold your thought. I know Chris and I always had pause when people in the past would talk about irrevocable trust. We always had a little bit of pause about it. And Chris, what were you going to say?
I was just going to say, we always talk about on air, update your will, make sure but can people update their trust?
So just to take a step back, there's two types of trust. There's an irrevocable trust and a revocable. So revocable, absolutely. If somebody sets up a revocable trust, the purpose of that, or the grantor retains the right to change it, amend it, do whatever they want with it. Irrevocable trusts, in short, no. But irrevocable trusts frequently have provisions that they keep some sort of a power of appointment where they could change beneficiaries, they could change trustees as long as they don't name themselves. So many times there are retained powers inside of an irrevocable trust. So it's not just that the grantor has given up total control. So.
Okay, well, very interesting stuff here. EG Tax here with your, get your tax questions in, get your estate questions in, your elder care. You guys were busy last week giving us a call. I know it's the Italian festival this week and everybody's eating the cannolis. But we're going to take a short break, and on the other side, we got more questions for Jeff. That's right. We all do. We got our sisters, our brothers, and we're talking today about making sure the money gets passed on to them instead of going somewhere else. But Chris Fabian, Tiffany Fabian from EG Tax, got 45 minutes left to answer your tax questions. We do have our special guest, Jeff Katz, in from Katz and Berry to talk about elder care and everything that goes with it. And I know last week we were mentioning it, and somebody emailed me a question. I think this is a very common question. Mom sold a home for $300,000, they said. Gave $75,000 to 3 of her children. She kept $75,000. Unfortunately, something happened. She had to go into skilled nursing, but the kids spent the money. So what happens?
Okay. Well, so the framework for that question is when And unfortunately, we do see that happen. When somebody goes into a nursing home, the question always is, how is it going to get paid for? So it's going to get paid for one of three ways. It's going to get paid for by insurance coverage if we have that. So that could be a long-term care insurance policy that in this question mom had bought to pay for the long-term care. If there is, and then there's also health insurance, which will pay for rehab. Medicare pays for up to the first 100 days of nursing home care for rehab. After that, though, it's either private pay or Medicaid. And what that question gets at is if the person is on Medicaid or trying to get onto Medicaid, Medicaid is a governmental program that helps people pay for, in this context, nursing home care, and will only pay if the person qualifies. So with the question, if they've given away money, in this instance, mom did give away $75,000, then if it's given away within the time frame, and the time frame is 5 years, there's a 5-year look back, then that money would disqualify mom for getting onto Medicaid, or would count against her with a penalty period. So she'd have to get the money back from the kids.
And if they spent it,
there's no money to give back. So at that context, then she would be ineligible for Medicaid for the penalty period of time that the $75,000, which, off the top of my head would be 5-6 months, and Medicaid would not pay the bill. So in that situation, parents have to be very careful if they are old and not well about giving away money to their kids.
Yeah.
Be very cautious, make the right decisions, make some phone calls, right, Chris?
Right. But I know, like with gifting, if they can choose a pattern, like if they show a pattern, like every year at Christmas time they give their kids $10,000, does the nursing home go back?
So
I shouldn't say nursing home, Medicare.
Correct. As you restated the question correctly, so it would be a Medicaid question, not a nursing home question, and there can be an argument made to Medicaid or to as part of the Medicaid application saying that there's been a pattern of gifting. So in other words, what you really can't do is somebody can't be going to a nursing home and then just give away all their money in the hopes of getting Medicaid to pay the bill. So if that's the occurrence, because otherwise everybody would do it. Everybody who would go to the front door of a nursing home would give their money away the day before. But if you can argue that the gifts were part of a pattern of gifting, as you stated, Chris, $10,000 a year every year, and if you can then prove that, then those gifts can become, in essence, an exempt gift.
Okay,
that's a good question.
There's a lot of stuff out there. People, it's very confusing. Getting older should get easier, and it doesn't.
Jeff, what if somebody right from the get-go is already covered under Medicaid? They're duly covered Medicaid and Medicare, and so then they want to go into a nursing home. Is it hard to get into a good, decent nursing home if you're under Medicaid right from the get-go?
Well, every nursing home in Erie County takes Medicaid.
Okay.
So it has many Medicaid patients or beds that are being paid for by Medicaid. But it is harder upon admission because if you are private pay,
right,
in essence, you go to the front of the line, and Medicaid arguably would go to the back of the line.
Okay.
So and institutions are allowed to do that to screen for financial wherewithal. So I guess the short answer is yes, you're at a slight disadvantage if you're on Medicaid for admission.
Okay, and then I know one of my patients, and she lives here, and she has long-term care insurance, and her son lives in Arizona, and he's thinking of having her go to a nursing home where he lives because he's the only relative in Arizona. So if she has long-term care insurance, would it be okay to be used in Arizona?
In short, yes.
Okay.
But we'd have to look at the policy. But very few policies are state specific.
Okay.
So because it's usually a national insurance company,
Okay.
so it would pay. But when you do move from state to state, you have to be cognizant of the Medicaid qualification laws in those states. And more important, I think, for our listeners, when parents are coming to Western New York, they'd have to make sure that they qualify as a New York State resident in order to qualify for Medicaid. The good news on that, though, is we have one of the easier states to become a resident of for Medicaid purposes. So.
That's great.
Oh, well, okay. I know we got a couple texts. One, I think we already answered, but we'll answer it. If you've given the money away before the 5 years to your family, can Medicaid go after the kids for the money?
Okay, so the key part of that is the before the 5 years. So the look back period for Medicaid qualification is 5 years from the date of application, or 5 years from the date that somebody goes into the nursing home. So if it's more than 5 years, if before the 5 years, so in other words, if it's 5 years and a day, or 6 years, any of that money that's given away to the kids is not countable as resources as part of the Medicaid application.
No. I'm sorry, my mind always goes. We're talking about giving to kids. What if the person who goes into the nursing home, before they do it, gave like the $75,000 to a church?
Okay, so what if you've given it away to? So it's given away, period. So you really aren't allowed to give away your money. If you're trying to then create a charitable legacy and give money to churches, obviously then that would be something you would petition or argue when we went through the Medicaid application to say it's different. You weren't trying to protect the money, because the issue always is that a person who's going into the nursing home is trying to shield the money for their family, or shield the money. So if you legitimately gave it to the church because you love and care about the church, then that certainly would be something that could be looked at on the Medicaid application process.
Okay. And let's go to Mike from Tonawanda. Hey, Mike.
Hi. I have a question. This is going back a few years, but when they had COVID, I was able to apply for unemployment because I wasn't working, but I can't remember, what dates those were and if I got any information on that. And if I'm responsible for that, how can I track that down? Because I haven't been able to find that in my paperwork at all.
So regrettably, New York State doesn't mail you a 1099 at the end of the year. You have to go onto your New York State unemployment portal, and you'd have to download it. And if you need help getting onto your portal, we can try to help you. But have you ever been on the New York State portal?
I think I had to be, because they asked me the questions like every week or whatever.
Yeah.
Right.
Have you been able to find work or whatever? So I could probably try that, but I don't know if I still remember my password.
Well, there's always forgot your password.
Yeah, there's an option for forgot your password.
And worst case scenario too, we could not even worst case. We could even call the IRS with him and get an income transcript for those years.
Yeah, and another sad part is New York State right now they're mailing out letters for 2019 because the statute wears off soon. So my point is that it'll take New York State several years to notify. Okay, whatever year.
No, I was going to say it actually expires today.
Okay, and so my point is they're not going to let you know until a couple of years have gone by. So then interest and penalty are accruing. So the sooner you find out and amend and fix those returns, the better. So again, to reiterate, they don't mail you anything, unless.
Okay, well, thank you very much.
You're welcome. If you need help, give us a buzz. Okay.
Will do. Thank you.
Thanks, Mike. Good luck. Okay, we got another text. I thought if you had a limited power of appointment in the irrevocable trust, allowing you to change the lifetime and residuary beneficiaries in the trust, that if your house is in the trust, it's considered an incomplete gift, and thus the asset is included in the grantor's gross estate for estate tax purposes, and thus causes a step-up basis on that asset. IRS Code 2038, trust assets create a step-up basis.
Well, that's actually a very sophisticated question. So that question gets right to what the new revenue ruling that we were just talking about. That's the details of that revenue ruling, which is it with it. So your question is correct. In other words, the person who texted in that question is correct. But and they've interpreted, or actually probably either interpreted or gotten advice on what the revenue ruling really impacts, which is the stepped up basis and whether or not the assets would be included in the estate for federal estate tax purposes, which, as we're talking about that, so in short, you are correct. I mean, you're in terms of the questioner they are correct the way that they phrase that their assets, if they've retained those rights, would not be harmed by this new revenue ruling, and they'd still get the stepped up basis.
And I think a good advice is, you said, anybody in this situation, it should be revisited, and you should look at the terms and just make sure, because anybody giving advice over a radio show is hard to do.
That's absolutely correct. So that's really, with this new complex revenue ruling, and if you do have an irrevocable trust, I would recommend anybody listening, take it back to the advisor who helped you set it up, or get other advice to make sure that it's going to carry out the way that you wanted it was initially set up, because this is a new IRS ruling. So
yeah, important.
Yeah.
Good question.
Yep. So 803-0930, 803-0930. Call in, get your questions. 716-803-0930. Text in your question. So yes, it's the same number, but you can text that number as well. I know we're coming up to the news. We got a couple more texts we'll get to, and another caller. Give us a call here. Give Jeff a call during the week, 633-3363. We'll catch you on the other side of the news for your other questions. And we're back. Chris Fabian, Tiffany Fabian from EG Tax. We got another half an hour to spend with you. We'll get right back to the text for Jeff. This one goes back to what we were talking about prior. And I think we misinterpreted what the person was texting, but he didn't answer the question if it's within the 5 years. We thought they meant it was past the 5 years.
Okay, so if it's within the 5 years, any money that's gifted away, so going back to that question, there was a $75,000 that mom had gifted away. If it is within the 5-year look-back period, then that money would, in essence, have to come back from the kids. And if the money has been spent, that's where the problem is, because kids can't give the money back. So that would then, upon Medicaid determination, that would render an ineligibility period. So the long and short, whenever you give away money to your kids and need to get on Medicaid to pay for a nursing home, it's a big problem.
So what would happen then to mom? Like, if she's ineligible for Medicaid, would the nursing home still take her even though there's no money?
So the issue normally is she's actually in the nursing home already. So she's been taken, she's living there, and then she gets this Medicaid application, which determines an ineligible period. So then the nursing home is not getting paid. So mom is actually going to be in the facility, but nobody's paying the bill for that period of time. And technically speaking, she's eligible. They can come after her. They can go back after any assets that are available. But it wouldn't affect her care. The good news, wouldn't affect her care. They can't kick her out. New York has an anti-dumping statute. They can't just kick somebody out. But again, from a planning perspective, we always have to be careful. Mom or anybody who's elderly who might end up in a skilled nursing facility has to be very careful if they give away the money so they don't end up in this scenario. Could
Medicaid then go, and you said they could attach a lien on mom, but could they attach a lien on her children?
So in this scenario, the lien would be this would actually not be a Medicaid lien, it'd be coming from the nursing home.
Okay. And
could the nursing home, in essence, sue the children to try and get this money back? And the answer is maybe. So which is not the best answer,
the money,
it depends and so
litigate,
but it would be. It's really not a Medicaid scenario, because Medicaid would just
said
rule.
No.
So Medicaid would say no, because you gifted away the money within the 5-year period. So that's what's really important for the listeners to understand is anytime money's gifted away within that 5-year look back period, it does create a problem on the Medicaid application. So
okay. So, and we'll go to the phones and talk to Craig from Tonawanda. Hey, Craig.
Hi. A few weeks ago, Esther was speaking about sometimes it's disadvantageous to convert to a Roth. How do I determine that?
Well, that's a good question. A very hard one to really get it. It's something we would have to really get into detail with. But the question would be, how much are you trying to convert?
This year only like 25,000. But
And then
other
I have a
years,
question. When you retire someday, are you going to have a government pension?
No.
Okay. And are you single or?
Social Security.
Yeah. So what Tiff is going at is if only your income is Social Security and you have just your 401k or your IRA, you probably, if you're single,
Aren't going to pay any taxes.
aren't going to pay any taxes on your minimum distribution.
So why convert it to a Roth?
Yeah. So why convert it to a Roth and pay the government money now? They would love you. Your
Yeah.
pocketbook may not.
Well, I'm a customer here, so I'll have to, when I come in to see Maria, I'll have to try to go over this with
Yeah,
you more.
definitely
because-
make an appointment with Maria. She'll go over everything with you, tell you what it would cost you.
But I think there's times, depending on how much you have saved and when the RMD gets up to a certain amount, that
I mean, there's times it is. I mean, if you put in solar panels and you have this huge credit and you don't have enough tax, then do a conversion to eat up the credit. So yeah, there are times where it is beneficial, but you have to run the numbers.
Yeah, and don't put it all in, and make sure you sit down with somebody before you do the conversion.
Okay. Yeah, I didn't know if I had to talk to Esther to get that done, and you to get that done, or if it was Maria.
No, Maria can run the numbers for you too.
All right, thank you very much.
Yeah.
You're welcome.
And the financial guys always have a really good point. There's something to be said for diversifying, for having some money into a Roth and some in a traditional. And there's, but maybe not. But like you said, solar panels. I mean, there's a time and place for everything. And to answer his question, Maria can answer that, or Chris or I. Doesn't have to be Esther, although she's got her own.
But, funny thing is he brought up Roths. Another new law that they snuck in there that no one's talked about because nobody really knows about it, is starting next year, so January 1st, 2024, if you're over age 50 and contributing to your 401k or 403b, and you're allowed your catch-up provisions, and your income's over 145, so there's a lot of hurdles, but your catch-up provisions have to go in a Roth 401k. So what is that telling you? The government wants money now.
That's a 145 single person?
Yeah. It could be also for married. So we don't know. I mean, there's not a lot of stuff out there, but it's
What year are they starting that?
January 1st, 2024.
Wow, that was sneaky.
Yeah.
So that tells you right there the government likes Roth, and so that should, I hate to keep using this word, but give you some pause, right?
Right.
Esther has a good saying. It's defer, 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 die.
Yep. And we're going to go to Mike in Akron. Hey, Mike. Mike?
Put him on hold.
I'm going to put you on hold for a second, Mike. Don't know what happened there, but he might be back now. There we go. Hey, Mike.
Hi. My big question is, a few years ago, I needed insurance, so I went on the New York State insurance plan. They put me on Medicaid. Mm-hmm. And I'm not quite sure why, but I've gotten benefits from it. And now I just got a check for $53.30 or something like that for Medicaid reimbursements. Do you know anything about that?
I don't know why because you're on Medicaid, they do pay you back for something you shouldn't pay for. But Medicaid for health insurance all goes based upon income. So when you applied, the way you answered their questions, you must have been under, and I'm just going to throw a figure, you're single, so I'm going to say about $21,000 in income, so they automatically put you on Medicaid for health insurance.
Do you also have Medicare?
I do have Medicare also.
So there's
I am married.
There's a new program. If your income is lower, they will pay you back for your Medicare cost every month, and I think
that could be what it is.
Yeah, they'll pay you back for your Medicare cost, and they'll put it into your account or mail you a check, and it's retro from when it's approved. So if it's approved in April and it took several months to get it, then you're going to have money from April, May, June, July. So if your income is lower, they'll pay you for your Medicare. It's a program.
I see.
And so that,
in this day and age, you really worry about scams, and I mean, it looks like a legitimate check. I don't want to do anything wrong.
Yeah. Yeah.
So,
what I would do
will.
on Monday or Tuesday is give New York State Medicaid a call. They answer the phone right away. I've done it with several of my patients, and you don't hold very long. So give New York State Medicaid a call. It's a 716 number. I wish I had it handy. If you need to, call the office, and they'll let you know where that money came from. Because you're right, you never want to cash a check without knowing exactly where it's from, right?
No, exactly, because I don't want it coming back on us.
Yep.
And okay, well, I appreciate that. They did give a number with the check
Okay.
Yep. So give them a call.
to check on that. Okay, you guys are great.
Thank you.
Thank you, sir.
Hopefully enjoy the extra money, right?
Well, if it's due me, yes, we will enjoy
Right.
it. We sure need it.
Okay. Thank you,
You're
sir.
So, okay, thank you.
Thank you.
Okay, and go back to the text. We had Mr. Katz prepare wills, etc., 22 years ago, and we think they need updating and maybe a trust created. How much is charged for a consultation to determine what needs to be done?
Well, certainly I appreciate your coming by 22 years ago, and I would recommend for anybody that it's been that long that we do revisit that and have make sure that everything's up to date. So please do give my office a call, set up a time to come on in. Relative to costs, the way that I would work with anybody who's an existing client and actually for most new clients, especially those coming through EG Tax, there would not be a charge for the initial consultation. And normally then we would determine what needs to be done, whether we need to update the wills, add a new power of attorney, write a trust, and then before we proceed, I would tell you exactly what it'll cost. So please do call the office at 633-3363 anytime and set up an appointment so we can review that.
And then, Jeff, one of my patients, they said that they did a will like 20 years ago, and they don't know where it is. They did it with a lawyer. Did they keep them microfiched, or is there...
Where is the original will is a great question.
Yeah.
And so what many people in Erie County do, and I do, so for all of my clients, including the client from 22 years ago, that will would be filed at the Erie County or the Niagara County Surrogate Court.
Okay.
But many lawyers do keep original wills. Some lawyers send their clients home with original wills. And the location of the original will is critical because we do need that for probate of the will. So, so that's why I like to file mine with the courts.
I think that's a great idea.
Good answer. And we're going to go to Sandy in Lancaster. Hey, Sandy.
Hi.
Hi.
Hi, Sandy.
I have a question regarding the gifting to children and the look back. And is there a dollar amount that would be considered in regards to the gifting? I mean, I know you spoke about the $75,000 that this lady had given to her children. I mean, is there can you give $1,000 to your son who turns 50 or 40? I mean, what's the figure amount that is involved in that?
So first I want to say under tax law, you can give up to $17,000 per person per year without doing a gift tax. But that's talking about apples and oranges.
Correct. So that's the tax. Tiffany's given the tax law part of that. From the elder law or the Medicaid perspective, there is no threshold. So in other words, it starts at $1. Wow. So that if you have given away any money, it would be subject to be reported and given back. So again, it gets back to the gifting. But as we talked about, if you're giving $100 to your kids for Christmas, that's not going to matter. It's really having given a sizable gift away, and So, but in short, there is no definition. There is not a $17,000 threshold. That's the gift tax threshold, which relates to taxes. So that has nothing to do with Medicaid planning. People ask me that question all the time.
It gets very confusing.
It gets very confusing. But in short, any money that's given away counts against you if you do apply for Medicaid for long-term care.
How would that be paper trailed? So you have a checking account and you pull out $1,000 that you're going to use to go on vacation. So how would that be paper trailed if that was gifted or that was for your personal use? I mean,
right. Yeah, I understand, Sandy. So when somebody applies for Medicaid, you have to when you apply, you have to give them 5 years worth of all of your, as you use the word, paper trail. You have to give them 5 years worth of all the bank statements, 5 years worth of your annuity statements, 5 years worth of your brokerage statements, wherever your assets are. And then it's actually audited and reviewed to make sure that there are no substantial transfers coming out of those accounts, so that they could be reviewed. So there is. Okay. So you use the word paper trail. You have to maintain the paper trail, and they do look at that. So.
Okay, that's wonderful. Thank you very much, and I appreciate your time and information.
You're welcome.
Thank you.
Thanks. Okay, we're up for our last break. We're going to take a short break. We'll get to your other questions. But Rob, hold on. We'll be right back. And we're back. EG Tax. 15 minutes left to get your questions in, whether tax questions or elder care questions with our special guest, Jeff Katz from Katz and Berry. We've had a lot of great questions. Last week we had one, and can somebody put a non-relative on a life estate on their home?
Okay, so the answer is yes. So what a life estate on the home is, and it's quite common, we do it all the time to try and help families with their planning, specifically try and protect the home in the event of that long-term care going to a nursing home is required. So you take your house that you own and you would deed it to a relative or even to a non-family member, and then they would take ownership of the home. And the grantor, the person who owns the home originally, calling her mom would then retain a life estate. Life estate means that it's still her home. She lives there. She pays the bills. She cuts the lawn, and it is really, she has the life estate, which is life ownership in the home. And that life estate can be most commonly it's given to children,
right?
But it can be given to next door neighbors or anybody else. But almost always it's to their children.
Yeah. Just thought it was a good question
from
last week. I wanted to ask. We'll go talk to Rob from Cheektowaga. Hey, Rob.
Hi, how you doing?
Good.
I'm a loyal listener. I missed the past couple weeks, so I'm sorry if you went over this, before. But there's a federal tax credit if you lease electric vehicle. And I was just wondering, how does that work? Is it like if you have a 3-year lease?
It depends on the make and the model of the car and if they applied for it. So I don't have all that information in front of me, but if you want to call me during the week at the office, I can go to the IRS's website.
And what do you mean they, Chris? The
car manufacturer.
That's yep. If the manufacturer applied for it, so there's a list, and there's certain manufacturers that apply to be part of the leasing credit for taxes, and there's a certain number that can actually get the credit. So if you give Chris a call, he'll let you know if that manufacturer that you bought the electric car or leased the electric car is part of that caveat, we'll call it. So give him a call at 632.
But in general, how does that work? Do you get, like, let's say, if you do a 3-year lease at $7,500, you get like $1,500. If the manufacturer's eligible, do you get like $1,500 off your federal tax for 3 years or $75?
Yeah, I actually have to look up the leasing part of it too, because I've never heard of the leasing side.
I thought of buy.
Yeah, it's always been purchasing.
Okay, because I thought I saw something where they snuck something, not snuck, but they had something in there with the, I think, with the, for leasing that made more like manufacturers eligible. I think that for the buy purchases was just U.S. content.
Yeah, I honestly couldn't answer that right now on the air, so I don't want to give any wrong advice.
Maybe next week you can cover it, Chris? Yeah, good question. Okay. Actually, we've got several car dealer salespeople that not work for us, but I do their return, and I do their return and a relative, and so I could also ask Kevin too.
Yeah, and we'll go to Paul from Alden. Hey, Paul.
Hi, I had a question about if you purchase life insurance for the, and you could, would that be taxable, or could they look back on that, or?
So life insurance is never taxable, payable upon death, but if you're looking at the 5-year look back.
Yeah, so life insurance, there's two types of life insurance just in the big picture. There's term life insurance, which does not have a value when you are alive. It would have a death benefit, and that type of insurance would have no impact upon elder law or Medicaid if you're going into a nursing home. if you have life insurance, the other type of life insurance that would be more of a permanent insurance, universal, whole life, those policies have a cash value. So is the life insurance you're talking about something like that would have a cash value?
Yeah, well, it just any kind of insurance.
Yeah, so if the life insurance has a cash value, which many people do, so they bought a life insurance policy a long time ago, and the cash value counts as an asset. So as an example, if somebody has a life insurance policy that has a $100,000 death benefit, which would pay, as Tiffany said, tax-free to the beneficiaries when they passed away, but during their lifetime, it has accumulated a cash value, and let's just say that cash value is $20,000, then the cash that's accumulated within that policy counts as a resource or a part of the assets of the person that would be applying for a nursing home or applying for Medicaid to pay for the nursing home. So again, cash value in life insurance is no different than a bank account as when it's looked at as an asset. So.
Okay. Yeah, I understand.
Good question. And if somebody cashes in that cash value and they give it away to somebody, this all fits into the
exactly
5-year look back.
Yep, that would fit into the look back if you cash in the policy and you give it away, or if you were to just give the policy away, which is actually a planning technique that we utilize quite frequently, because you don't really want to, if you're an elderly person who's looking to go into a nursing home, you don't want to cash in your life. The family, I would always say, wouldn't want to cash in their life insurance policy because, quite candidly, you've been paying for it for many years, and now you're getting more towards the end of your life where you would want to make sure you had the policy around to have the benefit, the death benefit be payable. So if you transferred away the life insurance policy, the amount that was transferred away in the cash value would be includable as again, the type of gift that we're talking about that could be penalized.
Okay. Yeah, I was just wondering another way to hide money someplace.
Yep, understand. But okay, thank you, sir. Okay.
Very complicated.
Very, very. And we got another call. We got Jeff, I believe. Hey, Jeff, how can we help you? Or did Frank get Jeff? Frank got Jeff. So okay, we got a rather long text. It looks something, and I'm going to get it all wrong. I'm sorry. They live behind mom. Mom has dementia, but they take care of mom. What happens if they buy mom's house?
Okay, so whenever a house is sold, okay, again, we're talking about Medicaid, we're talking about long-term care, then that we're turning a house into cash, and that cash would count as an asset, which would be used to pay for the nursing home, quite candidly. But if it was then protected or gifted away, it would be subject to the 5-year look back. So if a house is sold, it must be for fair market value. In other words, you forget the neighbor next door, or there's a question alludes to the neighbor next door or to your kids. You can't, if the house is sold for less than fair market value, then the difference between that sale price and the fair market value counts as a gift. So I think if I could read the text, it looks like that this person was trying to help mom through the years, and then they want to try and be cooperative and sell them the house. If it's for less than fair market value, then the difference between fair market value and the purchase price could be subject to being treated as a gift on the Medicaid application. So again, all these questions have kind of a stream of thought running through them. We got to be careful whenever somebody is going into a nursing home. We have to be careful about what has happened with regard to the assets, whether they're gifted, transferred, because we don't want to render mom ineligible to pay, in the nursing home. We don't want to make her admission harder, as Tiffany's question got alluded to earlier, and we certainly don't want to ever make it where there's going to be a penalty period and the family's going to get penalized or something bad is going to happen.
So in this instance, the texters, they should get the house appraised before they purchase it so they could prove what they bought it for and what the fair market value was.
Correct. The best way to substantiate, fair market value is through an independent appraisal done by a certified appraiser, and then you've got that for the files, and if the purchase price matches that, then you've got fair market value purchase price.
So nothing can happen.
Right, correct. So,
I saw somebody wanted to know about the Medicare give back. It can range from $25 to $144 a month.
Okay, so good. And then if parents have a home going to 5 children upon death, what is the most beneficial way to proceed? Example, will, trust, or deed, or life estate?
That's an excellent question, and I guess the short answer would be it depends. Not the best answer in the world, but that's really what we estate planning lawyers would help a family figure their way through. All different ways, will, trust, or deed with a life estate would help effectuate that transfer, but there's no simple answer. It's not across every family situation would be different. Whether a will is correct, which would then be transferred through probate, whether a trust, revocable or irrevocable, would be the right answer, or whether a deed with a life estate would be the right answer. So it depends on your family situation, and from that quick text, I couldn't give you a simple, across the board answer. It's one of those three, though.
I know when people always ask me, should I do a life estate? My first question is this going to be your forever home?
That's always, actually, Chris, very similar to my first question. So, because you don't want to do the transfer if it's not. So.
Because then that is a gift. And that goes back to the original beginning of the show where the cost basis comes into play, and the kids then end up paying tax if the house sells before the parent passes away.
Again, wonderful questions today, Chris. Absolutely.
Yep. So Chris Fabian, Tiffany Fabian from EG Tax, 632-7886 is our phone number during the week. Give us a call.
And Jeff's?
Jeff's phone number is 633-3363. I know that one off the top of my head. I call him a lot. But he'll help you too. I mean, again, planning. We talk about planning for taxes. Unfortunately, you have to plan to die.
Getting the plan right is very important.
Yeah. So, any questions for us, give us a call. Give Jeff a call. Until next weekend, enjoy your cannolis.